There are Japanese housewives who terrify Goldman Sachs. This is not because they have insider information or hiring teams of analysts with 3 PhDs each. They terrify Wall Street because they do almost nothing. They sit. They wait. They collect interest, like it's a boring government bond. And when the entire Western Hemisphere is panic selling during a crisis, screaming into their Bloomberg terminals with the heart rate of a hummingbird on espresso, these women are clicking buy on their phones between grocery shopping and picking up the kids. The collective name institutional traders gave them is Mrs. Watanabe. And Mrs. Watanabe has a better track record than your favorite finance YouTuber. This isn't a joke. This is documented in institutional Forex reports. When market analysts try to predict currency movements, they have to account for the Watanabe factor. Actual adults with economics degrees have to put "what are the Japanese housewives doing" into their spreadsheets. Because when Mrs. Watanabe moves, she moves with the combined purchasing power of a small nation. She's not day trading. She's not scalping. She's definitely not staring at the 1-minute chart at 3 in the morning eating cold pizza and questioning her life choices. She's doing the opposite of everything Western retail trading culture taught anyone to do. The Western small account trader has been sold a very specific fantasy. Multiple monitors, flashing numbers, rapid fire clicking. The vibe of someone defusing a bomb while also playing competitive chess. The idea is that trading should look like work, feel like work, and demand the same stress levels as air traffic control during a thunderstorm. This is not a strategy. This is performance art. The belief is simple and sounds logical. More trades equal more opportunities equal more profit. If professionals can make money trading, then doing it faster and more often should statistically accelerate success. It's the same reasoning that says if 1 aspirin cures a headache, then 17 aspirin should cure 17 headaches. The math doesn't check out, but the dopamine does. Scalping on high leverage gives the brain what it craves: immediate feedback, instant results. The emotional white-knuckle thrill of watching a number turn green or red in real time. It feels like trading. It looks like trading. It produces the psychological sensation of doing something important. What it doesn't produce is a growing account balance. But Mrs. Watanabe doesn't care about the performance. She cares about the interest rate differential. In Forex, this is called the swap rate or rollover rate. Every day a position is held. The trader either pays or receives a small amount of interest based on the interest rate difference between the two currencies in the pair. Western traders ignore this completely. It's too small, too boring. The swap on a single trade might be 40 cents. Who cares about 40 cents? Mrs. Watanabe cares about 40 cents. She cares about 40 cents per day per position, compounded over 6 months, while the Western trader has blown up their account 4 times trying to catch a 15-pip scalp on the EUR/USD. Her strategy is horrifyingly simple. Wait for a market panic. Wait for the moment when everyone is selling, and the news is screaming about economic collapse, and retail traders are closing their positions to protect capital. Then buy. Use absurdly low leverage, sometimes 2 to 1, sometimes 3 to 1. Then hold, just hold. Collect the daily interest. Ignore the noise. She is the counterparty to your panic. When the Western trader is slamming the close position button in sweaty terror, Mrs. Watanabe is on the other side, calmly absorbing that liquidity, paying wholesale prices for an asset everyone else just panic sold. And she waits. Boredom makes millions. Excitement makes margin calls. The candlestick chart was invented in the 1700s by a Japanese rice trader named Munehisa Honma. Most people know this. What they don't know is why he invented it. He wasn't trying to track the price of rice. He was trying to track the panic of the merchants. Honma figured out something that modern retail traders still haven't absorbed. The price of an asset is not determined by the asset. It's determined by the emotional state of the people trading it. The rice could be perfect. The harvest could be record-breaking. But if the merchants were terrified, the price collapsed. If they were greedy, the price launched into space. The candlestick wasn't a price chart. It was a psychological map. And the most important part of that map wasn't the body of the candle. It was the wick. The wick is where people suffered. Every long wick sticking out of a candle represents a price level where traders entered, held on with desperate hope, and then got obliterated. It's a graveyard, a receipt for pain. When a candle has a huge lower wick, it means price dropped fast, hit a bunch of stop losses, grabbed liquidity, and then reversed. The wick is a historical record of a massacre. And that's where Honma entered his trades. Not at the moving average crossover. Not when RSI hit oversold. At the exact price where other traders just lost everything. Because that's where the value was. Modern traders open their charts and immediately stack it with 7 different indicators. MACD, RSI, Bollinger Bands, Stochastic, 3 different moving averages, and maybe a Fibonacci retracement just for flavor. The chart looks like a fighter jet cockpit. It feels scientific. It feels professional. It is none of those things. It's a coping mechanism. The indicators create the illusion of control. They say, you're not gambling. You're analyzing data. You're making informed decisions based on mathematical models. But every single one of those indicators is lagging. They tell you what already happened. They are rear-view mirrors. Very sophisticated, very colorful rear-view mirrors. Honma would take one look at a modern trading screen and ask a simple question. Where did the crowd just panic? That's it. Not what is the RSI reading. Not where is the 50-period moving average. Just, where's the pain? Find the wick. Find the suffering. Enter there. This doesn't feel scientific. It feels predatory. And that emotional discomfort is why most traders won't do it. It requires accepting a brutal truth. Trading is not a collaboration. It's not a group project. Someone has to lose for someone else to win. Every time a retail trader gets stopped out and closes their laptop in frustration, then someone else made money. The question is whether that someone is you. There is a Japanese sword technique called Iaijutsu, the art of drawing the sword and cutting in a single motion. No hesitation, no second guessing, no internal negotiation between the decision and the action. One fluid movement from sheath to strike. The philosophy is simple. Hesitation in combat is death. Hesitation in a small trading account is liquidation. The number one killer of small accounts isn't bad strategy. It's not market volatility. It's not even lack of knowledge. The number one killer is the 3 seconds of hope. Right before a trader finally closes a losing position, the trade goes against them. Price approaches the stop loss. And then the internal negotiation begins. Maybe it just needs a little more room. It's probably just a spike. I know I'm right about the direction. It's just choppy right now. If I move my stop loss just 10 more pips, it'll turn around. And so the stop loss gets moved. The planned loss of $20 turns into 40, then 60, then 100. The trader is no longer trading. They're hostage negotiating with their own ego. This is not a financial mistake. This is a psychological defense mechanism. The stop loss being hit means the trader was wrong, and the human brain will do absolutely anything to avoid admitting it was wrong. It will burn money. It will ignore data. It will create elaborate fantasy scenarios. where the market realizes its mistake and comes back. The market does not realize mistakes. The market does not care. Moving a stop loss is the ego saying, I would rather lose everything than admit I was wrong about this one thing. It's the same reason people stay in bad relationships years longer than they should. It's the same reason someone doubles down at the casino after losing. The sunk cost fallacy doesn't care whether it's destroying a trading account or a marriage. The mechanism is identical. A small account can survive 50 tiny cuts, 50 small planned losses of 1 or 2%. That's annoying, but survivable. A small account cannot survive one severed artery, and that's what moving a stop loss creates. One uncontrolled hemorrhage that drains the entire account in a single trade. The Japanese answer is mechanical execution. The stop loss is not a suggestion. It's not a guideline. It's a pre-programmed reflex. When price touches the level, the position is closed. Not in 5 seconds, not after checking the news. Instantly, like drawing a blade. No hesitation between decision and action. This sounds simple. It is not even remotely simple, because it requires killing the part of the brain that believes it can predict the future. It requires accepting that the stop loss isn't there to be right. It's there to define the cost of being wrong. And that cost must be paid immediately, in full, without negotiation. Traders who master this survive. Traders who negotiate with their stop losses show up on Reddit 6 months later asking if there's any way to recover a blown account. There isn't. Time-based charts are lying. Not intentionally. They're not malicious. But they are lying by omission. And that lie is bleeding small accounts dry during every single sideways market. Here's the problem. A 5-minute chart prints a new candle every 5 minutes whether anything happened or not. The market can be completely flat, doing absolutely nothing, and the chart will still generate 12 candles per hour. 72 candles over 6 hours. The human brain sees 72 candles and interprets that as 72 events. 72 things happened. Surely one of them is a trading opportunity, but nothing happened. The market moved 4 pips in 6 hours. It was the financial equivalent of watching paint dry. But the chart created the illusion of action, and the brain, desperate for stimulation, starts hallucinating patterns. That's a bull flag. That's a triangle breakout. That's definitely a double bottom. It's none of those things. It's random noise being interpreted as signal because the chart kept printing candles and the trader kept staring at them. This is how small accounts get chopped to pieces. Death by 1,000 paper cuts during consolidation. Enter a long, get stopped out. Enter a short, get stopped out. Enter another long, stopped again. 5 trades, 5 losses, $50 in spread costs, and the market didn't even move. The trader wasn't wrong about direction. There was no direction. The market was asleep. But the clock kept ticking, so the candles kept printing, so the brain kept seeing setups. The Japanese solved this in the 18th century with Renko charts. The name comes from Renga, meaning brick. And Renko charts do not care about time. Not even a little bit. A Renko chart only prints a new brick when price moves a specific distance. If the setting is 10 pips, then a new brick appears only after price moves 10 full pips. If that takes 3 minutes, fine. If it takes 6 hours, also fine. If the market does nothing for an entire day, the Renko chart does nothing for an entire day. It just sits there. Blank? Honest. This is psychologically unbearable for most traders. They open the Renko chart, see nothing happening, and immediately switch back to the 5-minute chart, where there are candles and movement and the comforting illusion that opportunities exist. But the Renko chart is doing the trader a favor. It's saying, there is nothing to trade right now. Go outside, pet a dog, read a book, and do anything other than gamble your small account margin on random noise. Renko filters out the chop. It only shows actual momentum. And for a small account, where every dollar of margin matters, only trading during actual momentum is the difference between slow growth and fast death. The hard part is accepting that sometimes the right trade is no trade. That's not lazy. That's not missing opportunities. That's survival. The Ichimoku cloud looks like a nightmare. When a new trader opens a chart and sees Ichimoku for the first time, the reaction is immediate terror. There are lines everywhere, a shaded cloud, something called a lagging span. It looks like someone dropped a plate of spaghetti on a price chart and called it a strategy, and then they're told. The name means one glance equilibrium chart. One glance. The thing that looks like it, requires a PhD in computational chaos theory, is supposedly designed to be understood in one glance. This seems like a sick joke. It's not. The joke is that Western traders have convinced themselves that more data equals better decisions. That if they just add one more indicator, one more confirmation tool, one more filter, they'll finally crack the code. So they stack and stack and stack until their screen looks like a NASA control room, and they still can't pull the trigger on a trade because there's too much conflicting information. Analysis paralysis. The brain shuts down when given too many variables. It doesn't make better decisions. It makes no decisions. Or it makes random decisions and retroactively justifies them with whichever indicator happened to agree. Goichi Hosoda designed Ichimoku in the 1930s specifically to reduce screen time. The cloud, the lines, all of it, designed to answer one simple question in 3 seconds. Is there a trade here? Not, might there eventually be a trade if these 3 things align and RSI confirms and the stars are right? Is there a trade right now? Yes or no? If the answer takes longer than 3 seconds, the answer is no. Here's the check. Is price above the cloud? Are the conversion and baselines crossed correctly? Is the lagging span confirming? 3 questions. 3 seconds. If all 3 are yes, trade. If any are no, close the chart. This is brutal. This eliminates 90% of what a bored trader would convince themselves is a setup. And that's the point. Small accounts don't die from missing good trades. They die from taking bad trades out of boredom, desperation, or the crushing psychological need to feel productive. Staring at a chart for 45 minutes, analyzing every tiny movement, examining every possible angle, does not increase win rate. It decreases it. Because the brain, after 45 minutes of staring, will find a trade. It has to. The sunk cost of all that analysis demands a conclusion. So the brain manufactures a setup that isn't there, enters the trade to justify the time spent, and the account bleeds another 2%. The 3-second rule prevents this. If the setup isn't immediately, screamingly obvious, it doesn't exist. Ichimoku enforces that with visual simplicity. Either the trade is there or it's not. No gray area. No, maybe if it breaks this level. No, let's wait and see. Waiting and seeing is not a strategy. It's procrastination dressed as caution. The hardest thing a small account trader can learn is that doing nothing is sometimes the highest skill move available. Ichimoku makes doing nothing easier by making the decision binary. Trade or don't. 3 seconds, then walk away. There is a concept in Japanese martial arts called shuhari, the path to mastery. Shu means obey the rule. Ha means detach from the rule. Ri means transcend the rule. A student starts at Shu. They learn a single technique and practice it exactly as taught, hundreds of times, with zero deviation. No creativity, no personal flair, just ruthless, robotic repetition of the fundamental form. This is boring. This feels limiting. Every instinct screams to start experimenting, to add personal style, to innovate. The master says no, Shu first. Obey the rule. Only after the technique is burned into muscle memory, after it can be executed flawlessly without thought, does the student move to Ha. Now they begin to detach. They understand why the rule exists, and they start adapting it to their own body, their own style, their own context. And finally, after years, they reach Ri, transcendence. The rule no longer exists as a rule. It has been internalized so deeply that the practitioner moves beyond it entirely, creating something new that contains the principle, but is no longer bound by the form. Shu, Ha, Ri. Obey, detach, transcend. Small account traders live in a permanent state of trying to skip Shu. They find a strategy. They try it 3 times. They lose twice. And they immediately jump to Ha, deciding the strategy needs modification. Maybe the stop loss should be tighter. Maybe I should add a filter. Maybe this works better on a different time frame. They haven't obeyed the rule long enough to know if the rule works. So they modify it. The modification doesn't work either because they tried it 4 times. So they modify again and again. And within 2 weeks, the strategy is unrecognizable, and the trader has no idea whether the original system had an edge because they never actually traded the original system. Then they find a new strategy and restart the cycle. This is not learning. This is system hopping. And system hopping resets the statistical sample size to 0 every single time. Probability requires volume to materialize. A strategy with a 60% win rate doesn't mean 6 out of 10 trades win. It means over 100 trades, 60 will win. But if the trader never completes 100 trades on the same system, the probability never gets a chance to play out. They're pulling the slot machine lever 5 times, declaring it broken, moving to a new machine, pulling 5 times, declaring that one broken, and then wondering why they never hit a jackpot. The edge isn't in finding the perfect strategy. The edge is in executing an imperfect strategy, with perfect discipline long enough for the math to work. That requires Shu. Pick one setup. Trade it 100 times with 0 modifications. No tweaks, no optimizations, no, I think this would work better if 100 repetitions of the exact same rule. This is agonizing, especially around trade 30, when the losing streak hits and every fiber of the brain is screaming to change something. Change nothing. Shu. Obey the rule. The rule might be wrong. That's fine. But the only way to know if the rule is wrong is to execute it flawlessly enough times to gather statistical evidence. Changing the rule after 3 losses is not evidence. It's panic. And panic is not a trading strategy. Professional trading firms understand this. They give new traders one setup, one market. They're not allowed to trade anything else for 6 months. No exceptions, no creativity. Just the same setup every single day until execution becomes automatic. Only then, after proving consistency, are they allowed to expand. Retail traders think this sounds like prison. They want freedom. They want to explore. They want to find their own path. That's fine. But freedom without foundation is just chaos in a nice outfit. Shu first. Master one thing, then and only then move to Ha. Most traders never make it to Ha because they refuse to stay in Shu long enough to build the foundation. They spend years jumping from strategy to strategy, each time convinced this new one is finally the answer, never realizing the answer was never in the strategy. The answer was in the repetition. Heiken Ashi candles hide the truth from traders on purpose. And hiding the truth is exactly what most small account traders desperately need. Here's the pattern that destroys accounts. Trader enters a solid setup. The analysis is correct. The direction is right. Price starts moving in their favor. They're up $15, then $20, then $30. They're already mentally spending it. And then a sudden spike against their position. A long, terrifying wick stabbing through their entry like a knife. The trade is still open. The stop loss wasn't hit. But the heart rate just went from resting to cardiac event. They close the position in panic. 5 minutes later, the market continues exactly where they originally predicted. The trade would have made $100. They made $8 and an anxiety disorder. This happens over and over. Correct analysis, correct entry, panicked exit. The problem isn't the strategy. The problem is the wick. Those sharp spikes are liquidity hunts, algorithmic systems designed by people with mathematics degrees and no human empathy. The algorithms know exactly where retail stop losses cluster. They know the psychological price levels, round numbers, previous highs and lows, support and resistance zones. And they spike the price directly into those clusters, trigger the stops, absorb the liquidity, and reverse. It's not personal. It's just business. But the human brain doesn't process it as business. The brain sees a massive red wick shooting toward the stop loss and interprets it as a threat. Fight or flight kicks in. And flight means closing the trade. The wick is a weapon specifically designed to extract retail traders from winning positions. Heiken Ashi candles remove the weapon. Heiken Ashi means average pace. The candles use a smoothing formula. They average the price action. And in doing so, they hide the wicks. The terrifying spikes get smoothed into calm, consistent candles. The chart stays one solid color during a trend. No scary wicks. No panic spikes. Just a smooth visual representation of directional movement. This feels like cheating. It's not cheating. It's blindfolding the panic response. Sometimes becoming a better trader doesn't mean seeing more data. It means hiding specific data from the part of the brain that makes fear-based decisions. Heiken Ashi lets traders hold winning trades longer because the chart isn't visually screaming danger every 15 minutes. The market didn't change. The algorithms are still hunting. The wicks still happened in reality. But the trader didn't see them. So the trader didn't panic. So the trade stayed open. So the account actually grew. Ignorance isn't always weakness. Sometimes it's armor. Western trading textbooks teach breakout trading like it's gospel. The idea is simple. If price tests a resistance level 3 times, it's building energy to break through. The third test is the charm. Buy the breakout. Ride the momentum. This sounds logical. It feels scientific. And it traps small accounts at the exact top of the market right before it collapses. The ancient Japanese rice traders had a name for this pattern: Sanzan, 3 mountains. And the rule was the opposite of the Western textbook. When a market tries 3 times to break a high and fails, it's not showing strength. It's showing exhaustion. Each failed attempt represents all available buyers getting absorbed by sellers. By the 3rd peak, there's nobody left to buy. Everyone who wanted in already got in. The breakout at the 3rd mountain is a trap, a final liquidity grab. The market pokes above resistance just long enough for retail traders to pile in, and then it collapses. The Western trader sees the 3rd test and thinks, this time it'll break. The Japanese trader sees the 3rd test and thinks, This is where I short into their faces. It's not that one group is smarter. It's that one group read different textbooks. The highest probability trades happen exactly where the most confident amateurs are entering. Not because amateurs are stupid, because amateurs are predictable. And predictable means exploitable. When price tests resistance a third time and breaks out, the Western-educated retail trader has been trained to buy. They do exactly what the textbook said. They're following the rules, and the rules were written to make them liquidity. The Japanese habit is patience. Wait for the third mountain. Watch the breakout happen. Watch retail pile in. Then short it. Not because shorting breakouts always works, because shorting the third failed breakout works statistically more often than buying it. One group is following the textbook. The other group is selling the textbook to them and trading the opposite direction. The trader with a $500 account looks at the 1% risk rule and laughs. 1% of 500 is $5. A $5 risk per trade sounds ridiculous, insulting. At that rate, even a perfect trade makes $12. Who quits their job on $12 wins? So they risk 50%, $250, because 50% of 500 gives the trade room to breathe, gives it a real chance to make a real profit. This is very confident math attached to a very confident mistake. Because risking 50% means 2 losing trades in a row ends the account. And every strategy on earth, even the good ones, produces 2 losing trades in a row eventually. It's not a question of if, it's a question of when. And when it happens, the account goes to zero, and the trader goes to Reddit to ask about recovery strategies. There are no recovery strategies. The account is dead. The Japanese corporate philosophy of Kaizen means continuous improvement. Toyota used it to dominate the global auto industry. The idea is ruthlessly simple. Improve by 1% every single day, not 10%, not 50%, 1%. Because 1% daily compounds into incomprehensible growth over time, and 50% one time compounds into nothing because the second attempt blows up. Applied to trading, risk 1%, win 2%, do it again tomorrow. This sounds boring. It is boring. Boring is the entire point. The desperation to flip a small account fast is the psychological mechanism that keeps it small forever. The pressure to win big creates the conditions for losing everything. A $500 account risking 1% is not trying to get rich on Thursday. It's trying to survive the learning curve. It's trying to stay alive long enough for compounding to take over. And compounding is magic. But compounding requires time. And time requires survival. 50% risk doesn't survive. It's already dead. The trader just doesn't know it yet. After a loss, the trader opens a new position immediately, but double the size, double the leverage. The logic is crystal clear. Win back what was just lost. This is called revenge trading. And revenge trading is not about money. It's about ego. The loss wasn't just a financial event. It was the market saying, you were wrong. And the ego cannot tolerate being wrong. So it demands immediate vindication, immediate proof that the trader is not an idiot. The revenge trade is not a strategy. It's an emotional defense mechanism, and it destroys accounts faster than anything else. The Japanese concept of mushin means no mind, a Zen state of emptiness. No anger, no fear, no ego, no attachment. In trading, mushin is achieved by hiding the dollar amount. Only track percentages. Only track pips. When the screen says minus $47, the brain panics. When the screen says minus 0.8%, the brain processes it as data. Neutral, emotionless, just a number. The trader can't revenge trade what they can't emotionally connect to. This sounds like a trick. It is a trick. But if the trick works, it's not stupid. The 5-minute chart shows a perfect breakout, a clean triangle, textbook setup. The small account trader enters long. 60 seconds later, they're stopped out. They check the 4-hour chart and realize they just bought directly into 4-hour resistance. This is like trying to run through a wall because the floor tiles made a nice pattern. The 5-minute chart is not a strategy. It's a zoomed-in fragment of a much larger war. And trading the fragment without checking the war is how small accounts get obliterated by forces they never saw coming. The Japanese concept of kakehiki means battlefield strategy. You never engage the enemy without knowing the terrain. Applied to trading, never take a 5-minute trade unless it aligns with the daily chart. The daily chart is not optional context. It's the foundation. The 5-minute chart is just noise unless it's anchored to institutional momentum. This eliminates 90% of 5-minute setups. Good. 90% of 5-minute setups are traps. The market opens with a gap, a huge empty space where no price printed. Beginner traders panic. What happened? What do I do? The Japanese Sakata rules call this a window, and windows have one job: they get closed. The market always returns to fill the gap. Not always immediately, but eventually. So the strategy is simple. Mark the gap. Wait for price to come back and fill it. Enter there. No guessing, no prediction, just patience. The gap is not chaos. It's a target with a historical edge going back 3 centuries. The trader with a small account feels pressure every single day. Pressure to grow it fast. Pressure to quit the job. Pressure to prove it was worth it. This pressure causes catastrophic errors. Over-leveraging, over-trading, ignoring rules. Japanese corporations plan in 100-year cycles. They don't measure success in quarters. They measure it in generations. Applied to a small account. This is a 5-year apprenticeship, not a lottery ticket. The moment the timeline pressure disappears, the trading improves. Because the trader is no longer trying to win every trade. They're trying to build a skill, and skills take time. The desperation to grow the account fast is exactly what keeps it small. Extend the timeline. Remove the pressure. Trade like there's no finish line. Because there isn't.